Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our periodic Investors Observer members only workshop. Let's get started. All right, so here's our agenda for today. We'll talk a little bit about what's going on here at Investors Observer. We will look at a whole bunch of charts. I have some thoughts about inflation. We'll discuss the Fed rules in terms of the Fed sort of ruling the market right now. And then the rest is member-driven content. Yes, member-driven content. We had some people submit questions ahead of time. Thank you for those. We'll get to those. And then, yeah, any other questions you have during the presentation or have currently, you can go ahead and just put them in the question box, and I will get to them. You know, sometimes if somebody types in something while I'm on the subject, I'll just get it right then. Otherwise, we will get them at the end. All right, with that, let's get started. All right, so what's going on at Investors Observer is we built an app. It's only available for iOS right now. The Android will come later. We're working on it, but you know, it takes a while. So yeah, that will be later. The app has all the stock features from Investors Observer, no option stuff currently, but that's potentially on the table. As well as the My Portfolio feature. And also one of the big things about the app is you can get news alerts for stocks in your portfolio and watch list. We tried to filter it pretty carefully to try to include only the most important sort of news alerts. So you're not going to get, hopefully, 100 dings a day unless you have just a really big portfolio or a lot of watch lists. But yeah, you can get that, and we're not sending marketing or any other messages through that channel. So it is only news alerts about stocks that you care about. So that's a pretty good feature of the app right there. I know that's a thing a lot of people have asked us about for kind of a long time, and we're finally able to deliver it through the app. All right, so let's get started with charts. Here is the last year of the S&P 500. The blue line is the daily moving average, and these other lines are just some lines I have drawn, sort of over the past year as support and resistance. When we talked last time, we were just sort of breaking out of this range here. And then Monday, we pretty much bounced right off of the top of this range that I've identified, sort of where that came in, and the 50-day moving average. That's basic looking at charts. There's nothing really complicated about that. But yeah, that was sort of the first point of resistance when we started to go down there, where you would like to see some kind of bounce, and we got that. When you look at the S&P chart, the other charts are a little bit different, but that one worked out pretty well. So the NASDAQ, we're sort of well above any kind of moving average or old support like that. Probably I'll end up drawing a new line somewhere in this area here for going forward. Because that looks like it might be some support at some point in the future. But yeah, the NASDAQ is still looks better than the S&P does from that angle. The Russell 2000, so small cap stocks, is above the one support line I had there, but also well below the 50-day moving average. It's moving back toward it. That can be resistance on the way up, so we'll see what happens when it gets close to that. But yeah, that's sort of where we are there. But you can see it's been, we'll say, essentially flat since January. Up and down, up and down. I guess maybe the middle of March was the high, and it hasn't really done anything since then. So that's something interesting to watch that we'll talk about a little bit more on some of these other slides. And so, yeah, sort of with that in mind, what we're seeing here in terms of the differences in things, the S&P and the NASDAQ don't look that different, right? The NASDAQ sort of had a little bit longer breakout here than the S&P did, longer and steeper, but they don't look that different. The Russell looks very different. And so then when you start digging in and looking at stuff, here's Apple versus Jets, which is an airline ETF. Airlines are pretty much the ultimate, reopening economy sort of play, whereas Apple was a massive winner in 2020, just sort of as the money has to go somewhere kind of play. There's no alternative. But you can see Apple kind of took a nap here from late last year until earlier this month, really, or maybe late June. And then it took off, it set new highs. So it was going sideways longer than the S&P, but broke out about the same time. Whereas the airline ETF, rallied and peaked in the spring and has been sort of in a downtrend since then. Now the downtrend may have gotten a little overextended and be looking to bounce back here. We'll see how that shapes up. But you can sort of get a sense that there's a lot of sort of rotation and moving parts here. So S&P 500 versus the S&P 500 equal weight. Why do we look at an index or two different ways to look at the performance of the same stocks? The reason is the classic S&P 500 is market cap weighted, and the S&P 500 equal weight gives all the stocks an equal weight. So we talked, I feel like every time we talked in 2020, we talked about how sort of the 5 stocks at the top of the S&P 500, Apple, Google, Facebook, I'm forgetting the others, Netflix is up there. But yeah, some of those giant stocks were really pulling the S&P 500 higher, and some other things were sort of languishing, right? I mean, you can see here everything's going sideways. And then around the time vaccines started to get approved, the other stuff, right, not the big 5, started to kind of outperform. But here more recently, again, since late April, early May kind of time frame, the equal weight hasn't really set a new high, while the the big 5 are starting to catch up, right? So Apple's breakout is, I know these charts are a little bit different, but Apple's breakout comes at about the same time as the regular market cap weighted S&P 500 really starts to catch up here. And this is also the time when the airlines have sort of rolled over and started to go down. So we're seeing a little bit more of a rotation back. This kind of thing happens, right? You get rallies and then they correct. And so what can happen sort of internally in the market is, oh, well, we were doing this trade for a while, right? 2020 was about, those sort of big 5 and some other sort of pandemic stocks, your Zooms and Pelotons and things like that. But those things get a little extended, so then you rotate to other stuff for a while. But then that stuff maybe gets a little bit extended, so you rotate back. So this is another way to divide the market in terms of growth versus value. Again, you can see that value outperformed for a while here, but growth has started to come back about the same time that the S&P 500 equal weight started to outperform. And some of this is rotation, and some of it has to do with sort of outlooks for economic growth. So maybe somewhat counterintuitively, the value stocks are stocks that I would put in the bucket of things that benefit from a growing economy. Whereas the growth stocks are, and this was one of the reasons that growth stocks did so well in 2020, was growth stocks are your tech stocks, your things that have a story about where they can grow without needing the economy to grow, right? So something like Tesla, right, has a story where, it's a small automaker, but they have an exciting new technology. They can maybe capture a big piece of the market, and in 10 or 20 or 30 years, they can become the next General Motors. Whereas General Motors already has a ton of market share, it's really hard to imagine a situation where General Motors, makes some huge growth leap without just a huge growth leap in the economy. So so the growth stocks can typically sort of grow without needing a growing economy, whereas the value stuff, which is we talked about it before, I think, and I know we've had articles published about it recently, things you can hold, right? Like either, a window or something you could throw through a window, that kind of thing, are your value stocks, whereas the growth stocks tend to be a little more ephemeral. And so the value outperformed for a while, and now growth is starting to catch up, partially on some concerns about how strong the growth will be. Another way to look at this is say that, almost set a new high on value here, and then the Fed meeting happened. We'll talk a bit more about the Fed in a few minutes, but yeah, there's a lot of things going on right now that are sort of all coming together at the same time. All right, so Treasury yields. I circled this gap in the market a couple weeks ago, just because the yields were starting to trend down, and I noticed this gap, and the saying goes that gaps like to be filled. So we filled it on Friday, or maybe it was Monday's big push down that we filled it. In any case, where it seems like that may be a bottom for now, we'll see. But yeah, again, right, like Treasury yields rallied, and then they maybe rallied too far. And then also the Fed talked, and there's maybe now a few more concerns about economic growth than there were before. But one thing that's worth noting here is this is not what Treasury yields do when the market is worried about inflation, right? Like if you're worried about inflation, you're not buying bonds that yield less than 2% a year over 10 years. That's not that's not an inflation trade. All right, so speaking of not inflation trades, let's look at gold. Even, back in May, which I would describe as sort of peak inflation worry, gold wasn't even at its highest point for the year and wasn't at the highest point, of the past year either. So I think that's interesting, right? Like there's a lot of people who were talking about being worried about inflation, but there were a lot of things in the market that didn't really indicate that inflation was necessary. I suppose another explanation for this is gold is not actually a hedge against inflation, but that's less of a concern for this particular thing. Some other things, right? Lumber. So here's lumber futures for September delivery. Lumber is down for 2021 at this point. It peaked back at the beginning of May. Again, sort of peak talking about being worried about inflation time, and has just been a ski slope since then. And not just that, but I was at, anecdotally, I was at Lowe's this weekend, and they've got a lot of wood, which, earlier in the year, the project I did this past weekend, I actually had delayed earlier in the year because neither Lowe's nor Home Depot, they just didn't have the wood that I needed in stock. It wasn't even that I wasn't willing to pay the price. It was they just did not have it. So this sort of supply issue seems to be easing. And then some other things that people talk about, copper peaked about the same time that lumber did. Copper is another thing that people look at in terms of economic growth. It peaked, but you notice it doesn't look like lumber, and it also doesn't look like gold. So this to me seems like a healthier chart for copper. I'd like to see it come back above the 50-day moving average. But this, generally looks like you're pricing in growth here, right? The chart, you're expecting you would expect some increases in price over time, right? It doesn't look like this where it ran way up and peaked and got extended and then fell. And it doesn't look like this where it's in a, potentially in a relatively long-term downtrend. Had a little bit of a correction here and it's gone sideways. But that doesn't really worry me. So yeah. All right, so some more thoughts about inflation. Reopening is a lumpy process, right? So even producers that aren't directly pinched by a shortage may have a customer who is, which limits what they can sell. Okay, so let's imagine you own a sandwich shop and suddenly your cheese guy can't fill all your cheese orders. Well, that cuts into the number of sandwiches you can make for sure. Okay, and it also affects the guy downstream from you who buys lunches for you and packages them with a couple other things to sell boxed lunches. But also, if you can't sell all the sandwiches you normally sell because you don't have the cheese you need, how long are you going to take a full bread order? Right? So at some point, your suppliers start to be impacted by shortages from your other suppliers. Okay, and you can back that up even further and say, well, if you're not ordering the amount of bread that you normally do, how long is your bread guy going to take a full flour order? Right? He's probably not interested in building a giant inventory there. He wants to buy it and make something and get it out the door. So it's kind of a lumpy process, and we'll talk about this a little bit more in a couple of slides when we get to the questions. But those sorts of things are kind of where we're at right now, where it's not just like, okay, well, here's a direct supply chain where you go from A to B to C, right? I mean, think about steel. You dig it up, you turn it into, you dig up iron ore, you turn it into steel, you roll it out, you sell it to somewhere who uses that roll to make something. That's a pretty linear sort of process, but supply chains are actually pretty complicated, and there's a lot more moving parts than just, the sort of trajectory of kind of one simple thing that goes from step A to B to C. You have to combine them with other things to make the complicated products that we all use. And so, yeah, we're still seeing a lot of shortages, and that has an impact on prices. Wages and housing are likely the stickiest parts of the recent price changes, right? Stuff like used car prices will go back down, right? Like the idea of used cars and new cars being at parity in perpetuity going forward doesn't make a ton of sense. So yeah, those prices will probably actually go down. The housing market, I would expect to cool off, right? We won't see this thing that we have now where, houses are on the market for, less than 10 days and somebody comes in with a cash offer and pays above the asking price. That's not a sustainable thing. We're already starting to see, at least some anecdotal reports of people getting tired of losing the bidding war for a house. I mean, you can look in certain areas and there aren't very many houses, right? Like I looked sort of in my area yesterday, and there's a few houses in sort of what I would call the upper price range, and there's a lot of land for sale. But yeah, I mean there are just very few actual houses at what I would call the low to medium sort of price range for sale. It's not sustainable, right? And so I think that will cool off. I don't necessarily think that we're going to see like a big drop in housing prices like we will in used car prices, but I think the market will cool off and it'll be at least easier to buy a house, if not necessarily cheaper. I think there's a lot of sort of demographic things that are also coming into play, right? For years we heard about, oh, millennials aren't, forming households, et cetera, et cetera. Well, that's starting to happen now. And yeah, when you form a household, one of the things you need is a house. So, we're starting to see a lot of those demographic things sort of come into play as well. And I mean, some of the other things that are big on the inflation front are like travel services, right? Airline tickets, rental cars. Those things the prices for those things have been rising, but are still below pre-pandemic levels. So yeah, they're rising and rising fast in some cases, but they're not just going to shoot past where they were pre-pandemic, because we know approximately what peak demand sort of looks like, and we have, as far as I know, the right number of, they didn't destroy a bunch of airliners during the pandemic. They parked them in the desert. They can pull them back out. And then we should have a relatively good match between the demand for airline seats and the supply of airline seats. Another thing that's interesting is Chipotle reported earnings yesterday. And yeah, their gross margins were up 10% quarter over quarter. Operating margin was up 15% quarter over quarter. And so there was a lot of sort of, noise and talk earlier in the year about how, raises for fast food workers were because of higher wages. But I mean, Chipotle is one of the ones that raised earnings, that raised prices and has said that they're raising earnings. But what this tells me is a lot of that price increase is flowing through to the bottom line. It isn't actually in wages, which is great for investors, right? Like you want to see the companies you own making higher earnings. But again, right, this says that, basically companies have pricing power and they can raise prices and people will keep coming in the store. And they can raise prices above and beyond what's needed to cover a wage price or a wage increase, and people will keep coming in the store, which is, again, fine for investors, but not really a sign of significant inflation. All right, so the other thing I wanted to talk about was, it's the Fed's market now, right? The virus is still putting a damper on things, but the trajectory seems pretty clear. I think the one potential exception to that is the new variants are potentially a wild card, right? Like Delta seems to be the worst one yet. It's more contagious, a bunch of other things. Vaccinations do limit the spread, and what causes the variant is, you get so many reproductions of a thing, you get a new thing, or at least a slightly different thing. And so you get more people vaccinated, you can limit the spread, which limits the variance. So that's the thing I would keep an eye on as an investor is, where are vaccination rates and are they still rising? Because that is one of the big risks in terms of where we are in the recovery right now is either a variation that breaks out or just the continued variations that continue to be slightly more contagious and get things, to just reopen slightly slower. But really the big driver of the markets now, as I see it, is what's called the Fed's reaction function. Okay, so this means that essentially interpreting things through the lens of what does the Fed do next. Okay, so we looked at interest rates and some other things earlier. And what happens when you get into this sort of market is the thing that we saw when we came out of 2008, and it lasted for a long time. Granted, that was a different recession. The recovery has been much faster this time. But you get what's called kind of the Goldilocks trade, or the good news is bad news trade, where economic data that's seen as being a little bit too good, what that signals to the market is, oh, the Fed might raise rates or they might stop their bond buying a little bit sooner than we expected. And so that ends up being actually sort of a negative for stocks. Whereas things that maybe come in a little bit on the weaker side can be a little bit more positive for stocks because they sort of imply that the Fed is going to stay lower for longer. And that's especially true for that growth versus value trade we were looking at, right? The growth stocks tend to be more highly levered. They don't need a fast growing economy. So those things tend to do pretty well in this kind of market, whereas the value stocks actually need the economic growth. So the Fed came in and what they did was essentially signaled, we're going to put a cap on inflation, and that kind of takes away some of the inflation risks, but it also takes away some of the potential economic growth, right? They're saying there is a limit to what we're going to call acceptable economic growth, and anything above that, we're going to try to tamp down. And so, you get the growth stocks coming back a little bit because of that. All right, let's get to the questions. So can you please comment on how to interpret the put-call ratio included in the morning update? So the put-call ratio is really just an indicator of sentiment. Calls are generally seen as bullish, puts are generally seen as bearish. Obviously, you can employ them in different ways. You can make a bullish trade out of puts. You can make bearish trades with calls. But by and large, most option volume is straight buying or selling, especially when you look at it sort of at this level. So parity, right? The same number of puts and calls would be a ratio of 1, right? That's just how division works. But people aren't generally positioned for the market to be flat, right? I mean, betting that the stock market should be flat, you probably better off taking your money somewhere else, right? If that's your expectation. And so in most cases, the ratio is much less than 1. Something around like a 0.5 is moderately bullish. I would say neutral is somewhere north of 0.5. Lower than that definitely gets more bullish, and then things that are higher and approaching 1 or above 1 are pretty bearish. And what tends to happen is, like a lot of sentiment indicators, these things kind of shift and then they hit an extreme and then snap back. Okay, so if you see a really high put call ratio in terms of, something close to 1 or something above 1, that might mean that a sell-off is about to reverse, right? Because sentiment has gotten super bearish, and then what happens is people go to the other side. The same thing can happen on the other side. When the put call ratio gets really, really low, that might be a good time to kind of look out. Just because, right? If everybody's bullish, it tends to distort prices and people start to find opportunities on the other side, and that can slow down a rally. All right, so this question is also from Stan. I'll try to summarize some of this. His question is basically about Taiwan Semiconductor. He said they had a positive earnings announcement, but the stock price seems to be fully valued. Do we think the share price has room to grow? Is the political risk from China, like a potential hostile takeover of Taiwan, weighing down the stock? And then he wanted to know about selling out of the money puts as a way to either generate income or secure shares at below today's market. Is the political risk significant enough to avoid, essentially this put selling strategy? So let's pull up some stuff on TSM and take a look here. All right, so I mean, generally in terms of, our valuation score, it sits kind of in the middle. In terms of the analyst ranking, it sits kind of in the middle. In terms of our fundamental score, it's, kind of in the middle, top but in the middle. This is what most of my portfolio looks like right now. That's nothing to worry about. It's fine. The thing I think is worth looking at on TSM here is the 1 year, and it gets even more dramatic if you make it the 5-year chart. So I think there was probably a case at points in 2020 where you could make a case that TSM was undervalued. I think we're past that now, right? Something runs up this fast, this far, this fast, it's really hard to make a case that it's undervalued at that point. And so then what you see here is it peaked and then it pulled back and it's going to kind of consolidate here. If we're talking about a long-term investment, yeah, I absolutely think there's probably has more room to go, more room to rise, but it is going to consolidate here. The PEG ratio and the EPS or the PE ratio aren't really too out of line with anything else that I'm seeing in this sort of industry. But yeah, I don't expect another run like this anytime soon because at a more than 600 billion market cap, it just takes a lot of money to do this again. Right, that's more than 50% increase in a couple of months. That kind of doesn't happen very often. So I think it's the days of it being undervalued are certainly past. All right, so the other things to think about here are that, so the idea of China invading Taiwan seems like sort of a tail risk, and what I mean by that is it seems to be not in the set of things that I would consider to be super likely, right? And yeah, I mean, trying to figure out how much of your portfolio should be in a particular stock based on something like that is really hard, especially because what does that look like? Does the U.S. get involved and end up going to war with China? At that point, I feel like if China does something and the U.S. and China get involved in a real shooting war, your Taiwan Semiconductor puts are probably not the biggest of your concerns. The other thing is, and I tried to look at some Taiwan Semiconductor stuff. Some countries or some companies break out, like percentage of revenue by region or country. Taiwan TSM doesn't do that. They do say that most of their revenue is generated in the Republic of China, which is what they call, which is their country, versus the PRC, or the People's Republic of China, which is sort of mainland China. But so a thing to think about is, right, sure, they're making a lot of their stuff in China. iPhone chips are made in China. Great, awesome. Lots of other computer chips, in Taiwan. Lots of other computer chips are made in Taiwan, but they got to go to China for assembly. So, yeah, China can put a real hurt on Taiwan Semiconductor without ever setting a single foot on the island of Taiwan. It's called, we're just going to stop importing things from Taiwan. I don't imagine they're really hot to do that, because it, right, really hurts their economy to do that as well. But yeah, remember those sandwiches from earlier, right? Like, demand for chips. Yeah, you got to have somewhere to sell the cheese that they're making. And if China just says, hey, we're just going to make sandwiches with no cheese now, Taiwan Semiconductor is kind of out of business in that regard. I don't expect that to happen, and eventually things would pick up. People will find other places to manufacture things. I don't necessarily mean out of business in the sense of bankrupt. I just mean out of business in terms of, if China decides to stop taking imports from Taiwan, a lot of their business goes away. But yeah, while demand for chips is generally pretty high, it isn't universal for all chips, because again, things are lumpy, right? I mean, if you're selling certain computer components and there's a shortage of another computer component, and people can't make a fully finished computer, how many pieces can you sell of your thing while the shortage of that other thing persists? So yeah, again, right, it's lumpy, it'll get ironed out. It's just, lumpy right now. And yeah, 105 puts are pretty far out of the money. The thing you didn't include here is an expiration date. So yeah, I mean, that's 8 or 9% out of the money with a stock at like 117. So you might be able to find a similar risk with a higher annualized return by looking a little closer to the money, but at a shorter time frame than whatever you're looking at that, especially if you're willing to buy more stock. If you absolutely don't want to take the stock, then you kind of want to push that as far down as you can. Maybe look at the 100 or the 95 even, and be 6 months out or something like that. But yeah, if you're willing to own the stock, selling puts is a certainly fine strategy. All right, so Stan had a question here in the chat. He said, can you explain the difference between the PE and the PEG ratios? So the PE ratio is essentially it's price divided by earnings. So essentially it's how much, for every dollar of share price, how much earnings are you getting for that? So let's go back here. So at a PE ratio of 31.4, for every dollar of earnings, you're paying $31.4 in share price. Okay, it's the EPS over the share price, basically. And the PEG ratio is that PE ratio, but divided by a growth rate, right? Because if the company's growing really fast, you'd be willing to take a higher PE ratio. If the company is not growing very fast, then you're not going to be that interested in a super high PE ratio. That was the wrong button. All right, so Cam said, I'm new to the stock market and a retail investor, and I want to know how to use Investors Observer to determine the right price to buy and sell a stock. Do we offer a buy zone or a sell zone? We don't have such a thing as a buy or a sell zone here. Those typically tend to be sort of very specific short-term traders who are using a specific strategy and analysis. Right, and yeah, it's not the kind of thing we offer here. We're trying to sort of cater to more investors than that. So depending on what you're trying to do, we have lots of ways to determine if a stock looks attractive, right? So for the longer term investor, the fundamental and valuation scores and metrics are much better suited there. I would put the analyst or the analyst rating in there as well. Whereas for shorter term and swing traders, the technical and sentiment indicators are typically better suited to those sort of investors. And you can use these things in combination, right? So one of the things I like to do as somebody who is, trying to pick up a few stocks at a value here for the long term is look for things that have a high valuation and maybe not a very high technical score. I think we actually have a screener for this. If you go to the stock dashboard, something like deep value or on the rebound, or high value potential reversals. Okay, what we're doing here is we're looking for things that have high valuations and low long-term technical scores. So the price has been going down or the price hasn't been performing along with the market, but the valuation is pretty attractive, right? That's how you find kind of buy and hold things. And you can use the other shorter term metrics, right? Like a low long-term technical score and a higher short-term score or a higher sentiment score might do something that lets you try to find a shorter term, like a momentum or a more technical sort of play using that same thing. So it's not just about the individual scores, but you can also use them in combination with each other, and sometimes in maybe ways in combination that you wouldn't think, in terms of like wanting a low score in some cases and a high score in some other cases to try to find sort of the right setup that you're looking for. All right, so this question was from Danny. He said, I'm a new member and I've been using the option screener to identify put call spread positions. Had good short-term success. The problem is I've never filled at our suggested premium amount. So one thing to do, right, is use limit orders, right? Like you'll get typically a better fill with a limit order than a market order. The market order, you're going to get basically the worst possible price for everything, right? Whereas you can a lot of times use a limit order, especially with options, and squeeze the market maker a little bit and just get a better price just by using a limit order instead of a market order. You get filled at the same time, the commissions are the same, but you get a better price using a different order type, because what you say is, I'm not going to take this trade for a different price than this or for a worse price than this. Those sometimes get you a better price, but never a worse price. You either get the trade at the price you want or you don't. And since market making is a volume business, and they don't get paid to sit around and not make trades all day, putting in that limit order, will frequently get filled at a higher price than just what the market displays in terms of, selling at the bid and buying at the ask. The other thing you can do, if you're looking at the option screener, is adjust the strike prices, right? So, if the stock is up by $1, and the options have dollar strikes available, just raise the strike prices by $1 and use the same credit. That usually works. That's another thing you can do. But yeah, generally in terms of trading, don't chase is a good rule. Getting filled at a bad price kind of starts you off on the wrong foot, especially with something like a credit spread where the profit is limited, and there's there's a direct relationship between the amount of profit you're going to get and the amount you have at risk in a credit spread, right? So the profit is that initial credit, and then the amount you have at risk is the difference in strike prices minus the credit. So if you get a smaller credit, not only is your potential return smaller, but also you now have more at risk than potentially that you were set up for. So that's another thing, right? It's just knowing when not to chase a trade is a pretty important lesson to learn in terms of trading. But those are kind of the big three there in terms of trying to get filled at the right prices. Use limit orders, adjust the strike prices if you need to, and then sort of don't chase things around just to try to get filled. All All right, that's everything that anybody sent in ahead of time. So thank you to everybody who sent in stuff ahead of time. Let's go through what's been submitted here while I was talking. All right, so let's start here. Gary asks if there's a platform that offers OTC, which is over-the-counter trades for free. Yeah, Gary, I think, I know Robinhood does not offer over-the-counter trades, but Robinhood kind of came in and forced all the other retail brokers to offer trades for free now. So I haven't checked, but I assume that most of the other brokers, your TD Ameritrades, etc., that offer commission-free trading are offering those trades on OTC stocks as well. So yeah, and there may be some minor commission. There's occasionally a regulatory fee or something that's pennies. But yeah, I think the answer is all of them but Robinhood at this point. I could be wrong there, but I'm not aware of anybody who has just okay, well, Sean says it's $5 a trade at E-Trade for OTC stocks. So there may be some there, but yeah, that's pretty cheap also. All right, so Umar said he wants to see some charts on PII and Peloton. Yeah, so Polaris makes off-road vehicles, four-wheelers, and I think some snowmobiles, stuff like that. This isn't, yeah. So the 5-year is pretty noisy, but this, all things considered, isn't that different from the Taiwan Semiconductor chart in terms of it had a big run up, and now it's just kind of going sideways. Yeah, that seems fine to me. It's not anything I'd be super excited about in terms of expecting a breakout, but also it wouldn't be alarming to me as a long-term shareholder either. Peloton might be a little bit different. Let's see here. Yeah, Peloton looks a little bit different. Peloton was a big winner in the pandemic in terms of, it's kind of a hot thing that people were buying when they had to stay at home and couldn't go to the gym. So you got a lot of hype and run up, but then it's been pretty noisy since then. And they've also had some recalls and some other stuff going on. So yeah, stocks like that, stocks that have a lot of news are generally a little bit harder to trade on technicals, right? Like all this technical stuff is great, but news will trump that, right? If your stock isn't, if a company misses earnings expectations or they have to recall their product or something like that, all of a sudden your technical stuff doesn't matter. Right, what matters is the news and what people expect about earnings and cash flow to be in the future. Do we ever sell in the money spreads expecting the price to fall or rise? Not 100% sure what you mean by that, Sean. So selling a spread is typically something that's done for a credit, and there aren't a lot of selling in the money spreads to happen. I mean, our diagonal spreads are an in the money spread, but as it's a debit spread, typically I would refer to that as bought. So I'm not 100% sure what to make of your question here. OCGN. Let's see. Yeah, this is another one that has a really fun chart. I mean, biotech kind of always does. Yeah, the difference between the 1 year and the 5-year chart is pretty stunning. So there's 1 year and there's 5 years. So yeah, I guess the good news is if you've been holding it for about a year, congratulations. If you've been holding it for 5 years, I'm very sorry. But yeah, in terms of what's going on with it, it's, yeah, all these biotech companies, right? This company doesn't make money, right? They're doing essentially very expensive science experiments in the hope of getting a product to market that will make a lot of money. I mean, that sounds flippant. Biotech is, very important work, obviously, right? That's how we get medicine. But in terms of investing, especially in these sort of smaller early stage companies that have, yeah, so what you'll notice here is clinical stage biopharmaceutical company. Clinical stage typically means they're only in trials, discovering, developing, and commercializing a pipeline, which again suggests they have some things they're testing, but not necessarily a product. Right, product candidate includes these things, right? There's nothing here that suggests they have a current product, right? So, right, again, they're just, doing science to try to find a product, basically, which will then have to be brought to market, etc. So these sorts of things are very high risk, high reward, and that leads to a lot of volatility. And also, everything I just said about news-driven stocks is, in particular, very much applicable to biotechs, right? Like you don't, yeah, I mean, to go from 10 to 16 is a 60% move. That's not really a technical thing. That's entirely, entirely news driven based on whatever it was that was reported that day. And so this is about sort of hope and people's best guesses about how the science is turning out based on periodic updates from the company. All right, we got another question about SRNE. This is one people ask about a lot. It's a pretty similar sort of story. I mean, the chart looks different. But again, right, like it's a biotech. This is kind of what they do. They're doing very expensive science to try to find a product. I don't, yeah. I can tell you the company doesn't make any money. I don't know that they have saleable products currently. But yeah, this is kind of what you get with biotechs. And yeah, I mean, the sort of frenzy of retail investors that have come into the market in the last year or so has sort of made some of these moves more pronounced. But biotech has always been a pretty volatile space. I personally don't really trade it. It doesn't really show up in our options portfolios and things like that, just because it's too unpredictable, right? I mean, one bad science experiment, one one bad science experiment or allergic reaction away from your trade going bad. Yeah, don't feel like I have any real advantage in terms of trying to pick that kind of thing. So I just choose not to play the game. All right, so Jim says he's not a paid member, but he's interested in how the daily morning action trade idea is chosen and the basis for the trade idea. So the morning trade idea is a covered call. It shows up in the morning update. So it looks like this is typically an at-the-money covered call. Relatively short term, and yeah, I mean, it's chosen on sort of a variety of factors. We try to avoid earnings if we can. Right, Pepsi reported last week, so they don't have earnings coming up. And then generally sort of look at, I would say it skews a little more technical, just because if you're doing a 9-day trade, the value metrics are much less relevant. Yeah, it tends to be mostly technical and not as fundamental, but there is, it's not no fundamental. It just tends to be less than it. If I was doing a 180-day trade, I'd care about fundamentals a lot more than I do at 9 days. Is really kind of the story there. All right, so when we send alerts about directors buying and selling a company stock, are we sure they aren't grants or executive compensation? Yes. So we get most of those from not that one, this one. We get most of those from our news feed here, and the news feed is compiled from SEC form number 4, which is the form people have to file if they're company insiders and they're changing their ownership of stock, and those forms are marked in terms of sale or purchase, right? Also, there are, see if I can find one that has some buying. It's been a little hard to find buying recently. Yeah, so another indicator is that right, a purchase of 9,000 shares for an amount, right? That means that's not the value of the shares that suddenly came into his possession. That is what was paid for the shares, right? So if you're buying shares, it is sort of definitionally not your not part of your compensation, because you're buying it at the market price. And so Eric said, do we have training videos on covered calls the way we manage it? He does covered call selling further out of the money. So we don't think we have any videos about how to manage a covered call trade that's at the money. I would say, honestly, it's not that different from doing them far out of the money. The difference is you get assigned a lot more. So yeah, I mean, you tend to do covered calls on stocks you don't mind owning. You sell a call at the money, you get a healthier chunk of premium for your trouble. And then yeah, because you don't need the stock to make a big move, you get assigned more often, so you can kind of turn that position over and get go find a different stock or the same stock. Either way, as far as that goes. But yeah, it's not really that much different to manage. It just tends to turn over faster because you get assigned more. All right, so Jim wants to know about the intraday trade alerts. So those are found in our Investors Keyhole service. They come out by email, but they're also on the website here. And they tend to be vertical credit spreads. They're usually plus or minus about 10% out of the money. Typically, yeah, almost always less than 90 days. A lot of times they're less than 30. So there's that one's a little bit closer to the money than we normally would do, but it seems like a representative sample otherwise. Yeah. All right, I think that's everything. Let me swing back through here. If anybody has any other questions, by all means, put them back. Let's see, somebody asked about XLE earlier. Yeah, so XLE is basically a proxy for oil. Right, I think there's maybe a few non-energy companies in here, but it's basically Chevron and Exxon and things like that. So yeah, it's doesn't look great over the last 5 years. It looks a lot better over the last year. I don't, yeah, I'm not a commodities trader for a reason. I don't have a great sense of exactly what the oil market is like. I feel like we're getting to close to a point though in terms of the price of oil where probably you start to get more production in the US. Right, fracking tends to be expensive, and so they have a higher break-even cost. So if the price of oil is at 40 and it costs you $70 to make a barrel of oil, you're just going to stop making oil at some point. But when the price gets back up to somewhere above whatever your break-even point is, then you sort of turn things back on. So that tends to serve as kind of a limiter in terms of how far up the price of oil will go, because there's a lot of oil here in the U.S. and it tends to sort of go up and down with the price a little bit more. Like I forget, Saudi Arabia's break-even price is I think somewhere in the 20s, and Russia also has a pretty low one, and they're the two big producers. So yeah, I don't. All of this is to say I don't really know. I don't. Yeah. It pays a big dividend. I can say that. That 4.4% is nice. I don't know if there's a huge. I mean, if you look at the all-time chart, I feel like the top is kind of in here, right? I mean, 2014 was the last time it set a new high. I don't know that I expect it to get back to there, but can it go sideways and pay you 4.4% for a while? Probably. So as far as that goes, I think it's probably okay. All right, a couple of cannabis stocks here. I don't think I know that one. BFF. Yeah, so cannabis stocks are interesting. Cannabis is illegal in the United States at the federal level, although it is becoming more and more accepted. At the state level, but that does create some potential problems for cannabis companies. They can have trouble getting bank accounts, things like that, which is not, yeah. I probably wouldn't buy a stock in a company that couldn't get a bank account, which is not to say that these publicly traded stocks can't get bank accounts, just that, those are the sorts of problems that you deal with when your product is illegal in the United States. Granted, a lot of these things are in Canada, or they're selling CBD oil, things like that. Generally, I think it's a growth sector. Something like this is interesting because this company just seems to do a lot of stuff, right? Like they've got greenhouses for vegetables. It produces power through means that are uncertain based on looking at this. And then also cannabis. And so, yeah, growing plants has historically been a pretty low margin business. Right? Like that's just kind of how that works, right? Like if the guy that farm over from you wants to drop the price by a nickel, now you have to drop your price by a nickel, or you're not selling anything. So you basically break even and try to make it up in volume. And so I'm not, yeah. I'm not sure what to say about companies that are strictly agriculture, because there are a lot of big agricultural giants in the United States that I feel like could come in and just sort of knock those companies off the map, if they were so inclined. They might buy them all up, though, which would be nice. What I do think probably has a little bit more certain future is companies that make a branded consumer product, right? So growing plants, always kind of risky, right? But if you have a product that people know and like and can put a brand on, that seems like a better business to be in as far as this goes. Just because, again, right, somebody might come in and buy you up, but they probably won't. There are legal protections against making the same product as you, and trying to steal your brand and just knock you off on price. Which is not to say it can't happen. It's just a lot harder to do that than it is to grow a plant and sell it for slightly cheaper. And that's sort of my general feeling on the entire cannabis industry. All right, so Danny says, in reference to the credit spread question, is there a general rule when it comes to the amount of risk and reward percentage? Yeah, so that gets to be interesting, because so if we go look at the options screener, oh, it's too late. Okay, so there's risk and reward, and then there's sort of probability of success. And so if you have a trade that's very far out of the money, you're typically going to have a sort of out of whack risk and reward ratio, in terms of you're not going to get a huge credit for the amount of money you have at risk. But that trade has a pretty low likelihood of being, of going bad. So it's a pretty high likelihood of success, but pretty low risk reward. So, for things like you find in the screener where they're pretty close to the money, I typically try to stay at 30% or a little bit higher, unless I feel really good about the stock. So like, I don't think you actually mean 60% out of the money. You don't find very many option trades at that point. So Charles, we're discussing a number of ways to potentially get option stuff into the portfolio tracker. I don't really have a date or a roadmap or anything like that right now, but yeah, it is a thing that we're considering. Dividend-bearing bank stocks for option trading. So I'm not sure what you mean by dividend-bearing bank stocks for option trading. Maybe for selling calls against, like if you're buying options, the dividend doesn't really come into play very much. But yeah, I think the bank stocks are fine. Bank stocks are definitely in that sort of value category we talked about. That is one sort of place I would caution you there is, in terms of the value versus growth dynamic, banks are decidedly in the, they're not, well, they did in the run up to 2008 invent a lot of exciting new banking products. And I think we all kind of know how that turned out. But generally, they're not inventing a lot of new exciting banking products. And so what you need for bank earnings to grow is typically an economy to grow. And so it's going to be maybe sort of less exciting, sort of to imagine the right side of this chart here than it was here when we got vaccines and we're like, okay, hey, we're going to get out of here. The economy is going to reopen fairly soon, and then things started happening. Maybe less exciting than this in terms of that 50% gain in a couple of months. But yeah, bank stocks, especially the ones that pay a decent dividend, are certainly fine. And if you want to sell a call against it now and again, I think that's probably okay. All right, I think that is all I have to say. It seems like the flow of questions has pretty much stopped. This session, like all of our workshops, was recorded. So we'll be sending out a link to the video tomorrow. where we'll post that on the website as well in case you don't get the email. So yeah, and our next workshop will be in about 3 weeks. So be on the lookout for invitations before then. If you have questions between now and then, you can open a ticket through our support system here, and we get back to most of those pretty quickly. So yeah, if you have questions between now and then, by all means, don't wait 3 weeks. Just send us an email or hit that help button. All right, thank you all for coming, and thank you for subscribing for Investors Observer.